Hello children, welcome back. This is Mousumi Chakraborty and today I will be discussing with you on the topic dissolution of a partnership firm. Meaning of dissolution of partnership firm. According to section 39 of Indian Partnership Act of 1932, the dissolution of partnership between all the partners of a firm is called the dissolution of the firm. The Act recognizes the difference in the breaking of relationship between all the partners of the firm and between some of the partners, and dissolution of a partnership firm therefore is the breaking or discontinuation of relationship between all the partners of the firm. Modes of dissolution. There are basically 5 modes of dissolution of the firm. That is, first, dissolution by agreement as per section 40 when all the partners give their consent for dissolution or in accordance with the contract among the partners. Second, compulsory dissolution according to section 41 if all the partners become insolvent or when the business becomes illegal. Third, dissolution of happening of some event, section 42. First, death of the partner, expiry of the term, completion of venture. Fourth, dissolution by notice, section 43 in case of partnership by will. And the last one, dissolution by the orders of court, section 44. If partners become of unsound mind, if partners are incapable of performing their duties or misconduct by the partner. Difference between dissolution of firm and partnership. Dissolution of partnership refers to the change in the existing agreement between the partner. In this, the business continues. The books of account of the firm are not closed. The economic relationship among the partners changes, although dissolution of partnership is not necessarily means dissolution of firm. It is voluntary in nature. But when we talk about dissolution of firm, it refers to dissolution of partnership between all the partners of the firm. The business of the firm comes to an end. The books of account of the firms are also closed. Economic relationship among the partners comes to an end. Dissolution of the firm necessarily means dissolution of partnership. It may be both voluntary as well as compulsory in nature. Moving on to the meaning of realization account. On dissolution of a partnership firm, all the assets and the liabilities of the firm are realized. First, the assets except cash in hand or bank and PL balances and all external liabilities excluding partners' loan, capital account, reserve fund and PL account are transferred to an account styled realization account at the book value, and thereafter the actual realizations are recorded. The external liabilities are cleared first and then the partners can take their dues. The partners can also take over the assets and liabilities at an agreed value. The actual realization payment of liabilities may relate to an unrecorded asset or liability including goodwill, and even such realization payment should be brought to realization account. The expenses relating to realization can also be debited to the realization account. The profit or loss on realization will then be transferred to the capital account in the PL ratio. Moving on to the format of realization account. Buy side, sundry creditor, bills payable, bank overdraft. These were the values of the external liabilities as per the old balance sheet. Then outstanding expenses, provision for doubtful debt, cash or bank, that is sale of asset, partners capital account, that is asset taken over by the partners, and finally the loss transferred. Moving on to the two side, land and building, plant and machinery, furniture, bills receivable, debtor are the valuation of the assets and liabilities on the old balance sheet. Then cash or bank account, payment of the liabilities, cash or bank account, payment of unrecorded liabilities, partners capital account, liability assumed by the partners, and finally profit transferred to the partners capital account in their PL ratio. Moving on to the difference between revaluation account and realization account. When we talk about revaluation account is related with the revaluation of assets and reassessment of liability. Its purpose is to record the fluctuated value of assets and liabilities and to calculate the profit or loss on revaluation. It is needed at the time of admission, retirement, as well as death of a partner. The profit or loss calculated in revaluation account is distributed among the old partners only. On the other hand, when we talk about realization account, it is prepared to realize the asset and to pay the liabilities. Its main purpose is to calculate profit and loss after realizing the assets and payment of the liabilities. It is needed when dissolution of the firm takes place. Profit or loss calculation is realization account is distributed among all the partners. The other remaining chapters will be continued in my next video. Thank you and have a nice day.